Hi friends, a very warm welcome. My name is Kirtan Shah. I head trainings for an institute called Ambition Learning Solutions, which is based out of Mumbai, India. We are in the services of rendering training support to students internationally preparing for international certifications in finance like CFP, CFA, FRM, etc. What we've understood over a period of time is all students appearing for these exams do understand what the books ask them to understand, and they only understand concepts to do with the exam. What is missing is the practical touch of what they've learned is versus how do they apply it to the market. So through the series of videos that we're going to upload on our YouTube channel, we are only trying to help every student across the globe try to understand the latest happenings in the financial markets and the causes, the concerns, and the reasons for the same so that they can update themselves along with what they read in the books with the latest happenings in the market. We intend to come up with such a video every week where we'll try and help everyone involved to understand what is happening currently in the capital markets and how should they be viewing that particular thing when that happens in the future. All that you have to do is just be a part of our YouTube channel, subscribe for it. You will receive such a video every week. The first video that I'm gonna try and focus on is to do with the latest happening in the market, because of which in India there is a huge turmoil in the equity markets. The Indian currency is falling like a pack of cards, and we see a huge turbulence on the bond yields. Now, why is it happening? And the reason for the same is something called as QE. QE is quantitative easing. Okay, so all I'm going to do is throw a little light on what exactly happened and why are the markets, be it currencies, commodities, or equities, behaving so erratic at this given point in time. Okay, all this started in late 2008 post the Lehman Brothers crisis. Okay, I'm sure all of you all have heard about the Lehman Brothers crisis, know what happened in the Lehman Brothers crisis, and will agree with me that post the Lehman Brothers crisis there was a huge liquidity crunch in the market. People did not have money, banks did not have money, and whenever there is a huge liquidity crunch, you will always see central bank of that particular country reacting to infuse liquidity in the system. That's exactly what the US central bank did. Okay, so US central bank started with measures to help infuse liquidity in the system. Now, all that you involved in the financial markets would know liquidity is typically infused in the system by two very common methods. First is called OMO, second is by decreasing interest rates in the market. Okay, what is OMO? OMO stands for open market operations. Okay, open market operations. Now, and when I'm saying reducing interest rates, we're talking about reducing the repo and the reverse repo rate, because repo is what is termed as interest rate. Now, what happens in an open market operations? In an open market operations, things are very simple. What does the central bank do? The central bank typically buys back the debt which is sold to the commercial banks. Okay, so you have the central bank who buys the debt back from the commercial banks. Okay, and for that the central bank will pay the commercial bank, hence liquidity with commercial bank will increase, and hence commercial bank will start lending money, which will kind of get rid of the liquidity crunch that people are facing in the market. So that's what typically OMO means in short. Okay, now what happened is, like I said, post 2008, after the Lehman Brothers crisis, there was a huge liquidity crunch, and to infuse liquidity in the system, the US central bank did exactly the same. They started with open market operations, which they called as quantitative easing. Okay, typically it is called QE in the market. Okay, so they started with quantitative easing one, where they started buying the debt from the market, from the banks typically, and they started paying them money. When they started paying them money supply in the market increased, and hence liquidity to a certain extent was taken care of. Okay. Once they saw that when the liquidity was infused in the market, it was actually helping the economy revive, okay, is when they stopped the first quantitative easing. Over a period of time, they realized that the market is again facing a little problem, is when they started quantitative easing 2, where they did the same thing, bought debt back from the commercial banks, gave them money, and that money was infused in the system, which helped the market revive. Again, over a period of time, they realized things were stable and hence they stopped quantitative easing 2. Now what is running currently is called quantitative easing 3. Now what happened is, like quantitative easing was start and then stopped, like quantitative easing 2 was start and stopped. Quantitative easing 3 is buying $85 billion worth of debt every month, which means that the US central bank is buying $85 billion worth of debt every month and infusing $85 billion in the market. Okay. What happened lately was, a week back, Ben Bernanke, who is the US federal chief, came out and made few very important points in one of his speeches, which actually led to what you're seeing today happening in the market. So let's throw some light at what exactly did he mention. He mentioned a few points. First, he mentioned saying that the US market or US economy is recovering because of the quantitative easing, which was positive. The second thing he mentioned was saying, if the US markets and the US economy is going to revive the same way he is anticipating, then by the late 2013, he is going to tap down the quantitative easing 3. What do I mean when I say tap down quantitative easing? Is he's going to reduce the $85 billion worth of debt that he is buying every month to a new value which is lower than 85 billion, let's say 40 billion. Now please don't go on the value, this is just a random value to help you understand. The third thing he said is that if everything goes well like he is expecting, then probably in mid 2014 he is going to stop quantitative easing 3. Now, post this statement was made, you saw effects on the market. Let's start. What happened to the equity market? The next day, the Indian Stock Exchange opened 500 points low. Okay. What happened to the Indian rupee? Okay. The Indian rupee hit lifetime low of 59.9850. What happened to the debt market? The debt market hit a lower circuit in India. Now please understand, these are huge effects. These are not normal trading days where things go bad and are recovered. These are serious moves. Now just because of the Ben Bernanke speech which came out, okay, which actually highlighted these things, why do you think such huge effects took place in the Indian market on equity, rupee and debt? That is exactly what I'm here to help you understand. And let me start explaining to you the same. Okay, let's start with debt first. Now, what was quantitative easing? Quantitative easing, or OMO, is the central bank buying the debt from the bank, typically the illiquid debt. Okay, so banks will sell the debt back to the central bank and central bank will pay money for the debt that they buy back. Now please correct me if you understand this well. What is the central bank doing in this particular case? The central bank is buying debt. Correct? Right. Now when you have a central bank who's buying debt, this is typically a positive situation on the debt market, that the central bank itself is buying debt. Now in the Bernanke speech, he said that he is going to tap down buying debt in 2003. Now please understand, when one of the biggest economies in the world and the central bank, which is rated amongst the best in the world, says that they are going to slow down on buying the debt, this obviously has an effect where people understand that now buying debt is not the right way, and hence what will they go ahead and do? They will start selling debt, because the best central bank or one of the best central bank in the world is going to slow down its buying of the debt, and hence the situation or the psychology in the market would be that when the best central bank is going to stop buying debt, okay, all the debt long positions that the market had saw selling, okay, which means there was a huge selling in the debt market in the US, and there was a huge selling in the debt market in all the emerging market places. Okay, now the point to be understood out here is simple. When the central bank in the US stops buying debt, it is understandable that the US debt market should fall. Okay, because people will start unwinding their long position because the central bank is not going to buy anymore, or is rather going to stop or reduce buying further. Okay, so it is understood that the debt market in the US will typically fall. But why did we see the Indian debt market hitting a lower circuit post this particular announcement? Let me throw a little light on that. So the first point that all of us need to understand is a little about the debt market. Okay, so what happens in the debt market is, let's say for example, bond and interest rates. What typically happens is, when bonds start falling, interest rates start going up, and when bonds start going up, you will see interest rates falling, and vice versa. So bonds and interest rates share an inverse relation. Okay, now the point that you have to note out here is, why do you see the Indian debt market popular? You see the Indian debt market popular is because it pays a very high interest. Let's say for example, for our understanding purpose, the Indian debt market pays close to 8% interest. Now what happens in the US is, the US investors get typically paid close to 2.25%, and hence if you are an investor in the US and if you have an opportunity, you would rather put in the Indian debt which pays you 8% versus putting it in your own country which pays you 2.25%. So what happened is, in India, because we allow close to $20 billion worth of funds by foreigners to be invested in our debt market, we see a lot of foreigners investing in the Indian debt market because the interest rates were typically high. Okay, now what happens is, when the bond starts falling in the US, because Ben Bernanke is going to stop buying bonds and hence the bonds are supposed to fall, when the bond falls, the US interest rates, or rather yields, will go up. Okay, now if you are a US investor and you understand that interest rates in your own country is going up, what would you do? You would rather shift some of your money from some foreign country back to your home country, which is paying you a higher interest rate or a higher yield. That was reason number one why bonds in India were sold by foreigners. Okay, which is why it hit a lower circuit. Point number two, which is very important for all of you all to understand, is the currency effect. Now try and understand what am I saying. Okay, suppose I am from the US wanting to invest in the Indian debt market. What currency do I have? I have a dollar. Okay, now let's say $1 is 50 rupees. Okay, when I want to invest in the Indian debt market, which currency will I have to pay? I'll have to pay the Indian rupee. So what do I do is, I sell my dollar and take 50 rupees and invest this 50 rupees in the debt market. Please understand, when I have a huge quantum of dollars to be sold, okay, typically dollars will fall And when I have a huge quantum of rupee to be bought, rupee will go up, which is exactly is the case that happens always. Whenever you have foreign investors coming into your country, okay, they will have to sell their dollars and they'll have to buy the local currency to invest in the local market. So whenever FIIs and FDIs bring dollars to your country, they'll have to sell it, hence the dollar goes down, and they'll have to buy the Indian rupee and hence the rupee goes up. So simple. Whenever FIIs increase their investments in India, dollar falls. Dollar falls because they'll have to sell their dollar to buy the local currency and hence the rupee goes up. Now the inverse is also true. Okay. What is the inverse? Inverse is, we understood FIIs want to sell the Indian bonds because they are getting more interest rate in their own country because the yields are going to go up. So they'll start selling their bonds. Now what will happen when they start selling their bonds? When they start selling their bonds, what currency will they get? They will get rupee because they had invested in rupee denomination. Now can they take rupee back to their home country? No. So now what will they do is, they'll have to convert their rupee into dollar. So they will sell the Indian rupee and buy the dollar. Now what happens when they actually sell the debt, okay, and they convert the rupee into dollar? They will have to sell rupee, hence the rupee will go down. They'll have to buy dollar, hence the dollar will go up. Now understand, the FII came in at $1 equal to 50 rupees. Now when they start taking the money back, hence they start selling the rupee and they start buying the dollar, dollar goes up. So $1 becomes, let's say, 60, what you're seeing right now. Please understand, this impacts their investment in a huge way. Let me explain to you how. So let's say you are a US investor, invested $1 in my country, assuming that you will get paid 8%. Okay, so you invested $1, which means in the local currency you invested 50 rupees, expecting to get paid 8%. So what was your expectation? Your expectation was that on 50 rupees, 8% interest, you will get paid 4 rupees. And hence at the end of the day, your principal will be returned, 4 rupees interest will be paid to you. You will get 54 rupees. And when you convert your 54 rupees while going back into a dollar, you will get more than $1. Correct? So let's say for our example purpose, $1.2 is what you will take home. Okay, so for you invested $1, you taking home $1.2. That's exactly what your calculation is when you invest in the country. But now what is happening because of the currency movement? What is happening because of the currency movement is now $1 is 60 rupees. So when you sold the debt, let's assume you received 54 rupees back. Assumption. Okay. Now when you're trying to convert this 54 rupees into dollars, how much are you getting? You are getting less than $1. You're getting less than $1 because you will have to pay 60 rupees to get $1, but now you're paying only 54 rupees. So you'll get only $0.9. Example, let's not go on my math. So your expectation was that you will invest $1, take back $1.2. But what is happening is you're investing $1, you're taking back only $0.9 because of the currency movement. So, two reasons why the bond market hit a lower circuit. First, because bonds were sold in the US. Bonds were sold in the US. And bonds are inversely proportional to interest rates. Yield in the US went up. Now, when yields in the US went up, obviously any investor who is from the US would want to sell the Indian market bond and take money back and invest in the US market. Hence they started selling the Indian bonds because they were getting higher returns in the US bonds. Point number two is the currency movement. Is because whenever your foreign investors take their investment back, we just understood that the local currency falls and the dollar goes up. Okay, so the local currency fall attributed more selling is because of this what we learnt above. Okay, two main reasons why bonds were sold in the market and it hit a lower circuit. It hit a lower circuit. It hit a lower circuit in the Indian debt market. I hope this is clear. Now let's move to currencies. We understood that when FIIs and FDIs, by which I am saying foreign investors, take their money back, they will have to sell the local currency and buy their currency, and hence their currency goes up and our currency falls. Okay, but what we saw after the Ben Bernanke's speech was that obviously the US bond market fell and all the emerging markets, which we typically term as EM, emerging market bond markets also fell. Okay, hence when the bonds of all the emerging markets where people from the US had invested started withdrawing, they will fall. And typically all the emerging market currencies should also fall like the rupee fell. Correct, right? But what we've seen is that the rupee fell 9%, whereas all the other local currencies of the emerging markets fell only in the range of 2% to 4%. Now if whatever we've learned so far is correct, all the other emerging market currencies should also have fell close to 9%, but it did not happen. The biggest reason for that is today India has a current account deficit of close to 4.9% of GDP, which is the highest that the Indian economy has had so far, and hence the Indian economy saw such a huge rupee depreciation, whereas the other emerging markets did not. Now a lot of you all viewing this video might not know exactly how the current account deficit affects the GDP and hence the currency and all. So I'm gonna prepare a separate video on the same. So I will update you all. Please watch that for you to understand what I just mentioned and why rupee had such a huge fall versus all the other currencies. Okay, so that's a little on the currency part and the debt market part. Let's try and understand why did the equity market fell so much. Okay, now what happened is again the same story of the currency movement. Please try and pay attention. Our markets are dominated by foreign flows. So let's say for example 60% of the volume that takes place in India today is by foreigners. I may be wrong on the quotation of 60%, but all I'm trying to intend is show to you all that it's a huge amount of money that the foreigners pour into our country and hence our market moves. Okay, so by this I'm trying to say that when such a huge amount of money flows in from the foreign investors, okay, whenever foreign investors bring in money and buy stocks, our market go up, and whenever these foreign investors sell and take money back, our market falls. So our market is largely dependent on foreign inflows and outflows. Okay, now let's say the daily volume in the Indian market is close to 1,40,000 crore. So 1,40,000 crore is the daily average volume. Out of this, 60% is foreign money. Okay, now again the same situation. If you are a foreigner wanting to invest in the Indian market, what do? You have $1, you come to India, you convert your dollar into rupees. So you pay $1, you receive 50 rupees. Okay, when you sell huge quantity of dollar falls. Same what we've learned in debt. When you buy huge quantity of rupee goes up. So typically when FIIs come to your country, you see the situation that the local currency rupee goes up and the dollar falls. Okay, but now what happened is, because of uh, the selling in the bond market, a movement on the currency, you saw that the rupee depreciated. Okay, now try and pay attention. I bought in $1, got 50 rupees. I bought one stock, one share of a company for 50 rupees. Okay, now what I saw is, this share that I bought at 50 rupees, this equity that I bought at 50 rupees went to 55. So for me, I am making a 10% profit on my investment, correct? So I made 5 rupees on 50 rupees that I invested. So I made 10% profit on my investment. Now what happens? I sold the stock at 55. Okay. So I got 55 rupees. Now I'm planning to take this 55 rupees back to my country. Okay. So what do? I sell this rupee and demand for dollars. Now what do I see is that $1 is quoting at 60 rupees today. Again the same situation. So when I pay back 55 rupees, how many dollars do I get? I get only $0.95 back. How much did I invest? $1. I actually made returns on my stock. So the stock that I bought at 50 became 55. But because of the currency movement from $1.50 to $1.60, what am I taking back from my investment? Only 0.95. So what happens is, typically when the local currency, which is the rupee, falls, you will see foreigners taking money out of your economy because of the situation that I just explained to you. I hope you all have understood why the equity market fell, why the bond market fell, what happened to the currency. Okay, this is just a small attempt from our side to help you understand what is happening in the market right now. If you like it, we'll love to hear your comments on the same. Thank you so much.